This is Amazon's statement of operations for the second quarter of 2026. Look at the bottom line. Net income hit a staggering $62.6 billion. For perspective, their net product sales were $77.6 billion. A retail operation cannot mathematically generate an 80% profit margin. Amazon's profit engine achieved this through a sudden structural mutation rather than organic scaling. Retail sales, Prime memberships, and consumer hardware remain steady, well below the growth required to trigger a gain of this magnitude. The company traditionally viewed as the everything store is operating as a high-stakes venture capital firm. Back on that income statement, the actual source of the anomaly sits right here, under other income. Amazon recorded a $50.5 billion paper gain, representing an upward adjustment in the value of their investment in Anthropic, an artificial intelligence startup. They didn't stop with one AI competitor. During that exact same quarter, Amazon took $15 billion in cash and bought Series C preferred stock in Anthropic's primary rival, OpenAI. And the filings show that $15 billion was just a down payment. Amazon signed a letter agreement committing to purchase an additional $35 billion in OpenAI stock. Between the valuation spike of their Anthropic holdings on one side and $50 billion in total commitments to OpenAI on the other, Amazon is simultaneously funding the two largest artificial intelligence pipelines on the planet. By pouring staggering amounts of capital into the top two competitors at once, Amazon has uniquely positioned itself to dictate the financial future of the AI boom. That $62 billion net income figure is a Level 3 fair value accounting adjustment. It represents theoretical value from private funding rounds rather than cash flowing in from daily operations. Stripping away the paper gains, this table reveals the actual operating engine. Consolidated baseline sales grew 20% year over year, but the outlier is Amazon Web Services, surging 37%, translating to over $42 billion in absolute sales for just one quarter. So while the headline profit is inflated by accounting rules, their actual operating income, the hard cash generated from running their business, was $27.4 billion. Maintaining a 37% growth rate at that scale proves that demand for computing power is rapidly accelerating, and Amazon's grip on the underlying infrastructure is only getting tighter. However, fighting a multi-front war to dominate global computing infrastructure requires capital outlays that even Amazon's operational cash flow cannot cover. This is their long-term debt schedule. By June 2026, Amazon carried over $132 billion in unsecured senior notes. To build their war chest, they issued $37 billion in new notes in March of 2026 alone. Immediately after the quarter closed, Amazon went back to the well, issuing another $25 billion in notes. Taking on over $60 billion in new debt in a matter of months to funnel directly into private AI startups and data centers is a massive financial maneuver. Amazon is intentionally loading its balance sheet with leverage to outspend every other competitor on Earth, effectively borrowing billions to buy the future of computing. Across the tech sector, competitors are making highly concentrated bets. Microsoft tied its fortunes to OpenAI early on, while Google focuses almost entirely on its in-house DeepMind models. Amazon avoided the single bet strategy. By securing massive stakes in both Anthropic and OpenAI, they effectively neutralized the risk of picking the wrong winner. The OpenAI deal includes a commercial mandate. The lab must run its models on AWS infrastructure and use Amazon's proprietary chips. They are providing the billions in funding that these AI labs desperately need, and then immediately requiring those same labs to spend that money renting Amazon servers. It creates a closed-loop ecosystem. Amazon extracts value from the growth of the AI market regardless of whether OpenAI or Anthropic builds the better product. Retail efficiency and logistics no longer serve as the primary metrics for Amazon's corporate identity. Structurally, the modern version of Amazon operates as a highly leveraged venture capital fund wrapped securely inside a global cloud computing monopoly. And as long as AWS continues to generate 37% revenue growth year over year, Wall Street will gladly finance their aggressive expansion. In the artificial intelligence arms race, Amazon built the track where every other competitor is forced to run.